Well, hello, everyone, and welcome today. Thank you so much for joining us. My name is Nicola Korzine, and I'm the Executive Director of the NASDAQ Entrepreneurial Center. We are going to have a really strong conversation today on a challenging subject that is facing all of us in this current time on navigating down rounds. But we are going to be doing so with tremendous experts to guide through a very important conversation today. Now, for those of you who are joining us for the first time at the NASDAQ Entrepreneurial Center, welcome. We're delighted to have you here. We're going to launch a poll just to kind of get a sentiment read on how everyone's doing today. So please see that up on your screen and respond if you will in kind, just to let us know how you are feeling in this current time. We are measuring this across all of our programs, and we'll be sharing this out as we go through. The NASDAQ Entrepreneurial Center is a nonprofit that provides truly invaluable resources for founders and leaders to learn, make connections, and grow. We have been established for 5 years and have been so fortunate to work with over 18,000 founders from more than 100 countries during that time. We look to offer all of our programs and resources for free. And so what we expect and hope in return is that you're able to pay it forward in the mantra that truly makes entrepreneurship great for all. For those of you who are returning back to us, welcome back. And we truly do want to recognize all of our sponsors and supporters who make this possible in the first place. So thank you to the tremendous companies and experts who really give their time, talent, and treasure to the support of entrepreneurs worldwide. We are so proud to be offering this series today as part of our extended program offerings in this time. These are part of our Learn In webinars, and they're hosted by true industry experts, as we're seeing today. So again, thank you for joining us for navigating down round financings with our amazing partners from Wilson Sonsini. We're going to get started in just a moment while everyone is joining us and logging on. We already have close to 200 attendees, so thank you for all of you for joining us today. As our current poll is up in front of you on feeling out how everyone is doing in this time, we're going to shift gears into better understanding who is joining us today. So what we're going to host now is a series of very quick questions in rapid fire. We'd love to understand as an entrepreneur what stage you are in, whether or not you have received venture financing, are you currently experiencing down rounds? And finally, what type of attendee are you? Are you joining us today as an entrepreneur, as an investor, as a curious onlooker, as a media participant? If you can just let us know on that. And we'll be sharing all of these results with you in just a moment. So please work your way through those series of polls. Again, thrilled to be welcoming everyone here today as part of this series of our learn-ins on navigating down round financings with Wilson Sonsini. We're going to get started in just 1 minute. For those of you who haven't seen in chat yet, we're going to be hosting Q&A right around the 11 o'clock series timeline with my colleague, Colin Mahan. So if you have questions as we're going through this content, please go ahead and drop those questions into the chat, and we'll get to them just as quickly as possible. And now, without further ado, it truly is my pleasure to welcome all of you officially today to get started with navigating down round financings with our tremendous partners, Wilson Sonsini. I have been so fortunate as to work beside this firm in one way, shape, or form for many, many years in Silicon Valley in the previous downturn and beyond. Steve Bachner is joining us. He is part of our board of the NASDAQ Entrepreneurial Center, a true leader and an amazing supporter of all entrepreneurs. I'm inspired to learn beside him truly every day. He is joined today with two amazing colleagues of his from Wilson Sonsini, Becky DeGraw and Amy. So please, without further ado, let me go ahead and turn it over to Steve to begin today's conversation. Again, thank you for joining, and we look forward to a tremendous conversation on navigating down rounds. Steve, over to you.
Nicola, thank you so much. And also thanks to you and the center for all you do to provide the content, the education, and the connections that entrepreneurs find so valuable, particularly in this climate. So thanks for all you and your team do. So we are going to, and by the way, everybody on the line, I hope you're all healthy and safe. I think we're all going through together a unique and difficult and tough environment. So stay well. So today we're going to review the topics you see on the screen here. We're going to start with an update on the fundraising environment, go to current market conditions and some of the considerations in down round financings. We're going to talk about some of the issues that boards face, that's the fiduciary duty landscape, and some of the bad cases from the past, what we can learn from some case law. And then try to give you some takeaways, what to do, both in terms of structuring rounds and terms we see in an environment like this, and we'll end with takeaways too. So hopefully we'll keep this practical and moving along. I am joined by two terrific partners of mine. First, Amy Simmerman is a partner in our Delaware office. She leads our governance practice, and she may be the busiest person in the firm, maybe the person that's called the most, because her expertise comes in these contexts, mergers and acquisitions, litigation context. So we're thrilled to have Amy from Wilmington, Delaware on the panel. And then Becky DeGraw is my partner in our SOMA office. And Becky is one of the leaders in our emerging companies practice, where she represents investors and companies in a whole range of transactions. So with that, let's talk a little bit about, to set the stage, kind of the environment we're in. And some of this I probably don't need to go through because we're all living through it, but it's kind of a perfect storm environment to sort of the down round context. We before this all started, we were in the longest bull market in history. It was fueled by low interest, creating a low interest rate environment, creating an opportunity and an interest in growth. We saw the evolution of very large venture funds, private equity funds, lots of cash on the sidelines, lots of competition for deals to deploy it, pushing up valuations. And then we had this unprecedented global event that affected all industries and geographies, with lots of volatility, market declines, and right now an incredible lack of visibility. We're tracking public companies, almost 400 of which have withdrawn or suspended guidance. So there's a lack of visibility on what the outlook looks like, which is understandable given we don't know how long this will last and when we're coming out of it. And I think all that plays into this down round conversation we're going to have, because all of this filters down to private market valuations, private market uncertainty, and a lack of visibility and outlook. And the other thing that's going on as a result of that, of course, is that the leverage is changing from companies and entrepreneurs having a lot of leverage with all that money on the sidelines and trying to be deployed, to an environment where I think we'll see investors have leverage and maybe more reluctant to deploy it. And as a result, as you might imagine, the terms get tougher, and we start seeing some things, and we saw these also coming out of the .com and the financial crisis, some tough terms. And on that, I'm going to turn it over to Becky to talk a little bit about that in a moment. But I want to say one of the things we're hearing a lot in board meetings is investors and board members telling companies that cash is king, make it through 2020. And so one of the techniques companies are using when they have to raise capital, those companies that don't have to may not be, because of the valuation and other terms they might see, which Becky's going to talk about in a moment. But these convertible instruments, this last bullet point, are being deployed by companies as a way to get in capital, either with a convertible equity instrument or a convertible debt instrument, to defer the valuation discussion down the road to maybe when there's more visibility about how this ends. So I think that's a technique we may see to avoid some of the tough down round terms that we're going to talk about next. So I'll turn it over to you, Becky, for what we're seeing in the market at the moment.
Great, thanks, Steve. So I'm going to go through these in a little bit more detail, but in addition to these types of onerous terms that we're seeing, we're generally seeing an overall slowdown in the deal pipeline as well. So the number of transactions that are getting done has decreased significantly. So some of the trends that are appearing, valuation decreases. We're seeing this in a few different few different ways. There's an overall dampening on valuations across the board. We expect this trend to continue, and we are seeing it both at the early stage and growth stage deals. Another way that valuation decreases are starting to creep into term sheets and to deals is by adding penny warrant coverage, which essentially reduces the pre-money valuation as well. These next couple, we're seeing a fair amount of activity in. So round sizes are being reduced as well. Lead investors are reducing their investments and requiring more participation from others. In terms of investments being tranched, we're seeing this as much as 80% being deferred until later, meaning only 20% of the total investment amount being put in at the initial closing. And then in terms of when does that additional funding come in, some of them are done through a period of time, just a passage of time, but most are tied to either some sort of milestone or performance metric that the company has to hit. On staggered sign and close, most financings prior to this get done on a simultaneous sign and close. But what we're starting to see creep into the market is sign now and delay the closing until some later time. And the time period that we're seeing there is maybe as little as 2 weeks, but as much as 6 months. So it could be a pretty significant time period there. And then also the lead investor is starting to require the full syndicate before closing. So instead of saying, I'll put my money in now, and we'll kind of let the rest of the round fill itself out over time, we're seeing more and more lead investors say, no, I want to see commitments from other investors at the same time that I put my money in. On structure changes, the biggest one we're seeing is switching from equity to bridge rounds, as Steve alluded to. And then as I mentioned above, warrants are being added to help bridge the gap on valuation concerns. The next few here, we're starting to see with some increased frequency. Liquidation preference multiples are increasing. So instead of the traditional one-time liquidation preference and a non-participating preferred, we're seeing 2 to 3 time liquidation preference multiples, and even seeing participating preferred with 2 to 3 time cap on their participation as well. On full ratchet anti-dilution adjustments, we're starting to see these creep in. In the past, we have very rarely seen these, but we're starting to see a handful of them now. One variation on this, instead of just having a full ratchet anti-dilution adjustment, is to say you'll have it for a period of time post-closing. So maybe for the next 12 or 18 months, when that's the period of time that there's a real uncertainty as to what's going to happen, that a full ratchet will apply to any transaction over that period of time. But then following that 12 to 18 month period, it'll go back to a broad-based weighted average. The other thing I'll say about anti-dilution adjustments is that a lot of existing investors are not waiving their current anti-dilution protections. So those are also coming into play. Most transactions are still being done with what we consider the fairly standard NVCA type reps and warranties of the company, but there are some investors who are asking to see kind of more M&A type representations be introduced. And then in a few instances, we're also seeing where founders are being asked to stand behind the reps and to give reps and warranties as well. Some companies are starting to make some pretty broad disclosures about the impact that the coronavirus is or may have on their business and operations. And in some instances, rather than trying to put some combination of these types of owners' terms in place, we're seeing investors just simply walking away and staying on the sidelines until some more certain times come. So not necessarily related to the terms and the financing itself, but some other observations that we're starting to see are longer diligence processes, longer on the business diligence side of things to get to a term sheet, and also longer on the legal side of things to go from term sheet to closing. In regards to debt facility drawdowns, a number of board members are recommending to their companies to go ahead and draw down on existing credit facilities that a company may have in order, as a precautionary measure. So we're seeing that happen as well. So as you can see, there's a variety of terms that are being introduced to the market right now, and it's pretty fluid, but everything is pointing in the direction of continuing in this direction and pointing toward more down round financings. I'm going to turn it back to Steve at this point, who's going to discuss some of the considerations in this context.
Yeah, thanks a lot, Becky. And yeah, I'll just echo what you said. We have not seen those kinds of anti-dilution provisions. And for those of you that aren't familiar with those, that's basically price protection, where the investor says, look, I'll give you money at this valuation, but you raise money at a lower price, we get that, or we get some adjustment. And liquidation preferences, multiple liquidation preferences, we haven't seen in quite a while either. And those are ones where the investor says, I get a multiple of my money back before you, the management team and employees, get anything. So yeah, it's those are the kind of things we saw creep out in the .com, post.com bust era and after the financial crisis, and we're seeing that kind of cast of characters emerge again. We're going to talk next about some typical down round considerations, and then I'll turn it over to Amy really to get into the meat of some of the difficult board considerations. But I want to say that even though we're talking about down rounds, many of the things that we're going to be talking about and Amy's going to be talking about are very relevant in other contexts, particularly involving board conflict. So these principles about board duties and responsibilities and process steps, hopefully you'll find useful for not only down rounds, we hope you escape those, but other board of director context as well. So let me just go through three kind of things that we typically see happen in this environment and people focus on. First, fiduciary duties. We're going to spend a lot of time on that because many venture-backed companies don't have truly independent boards of directors. And so as Amy will get into, boards usually are given a lot of slack by judges that say, hey, we're not going to second guess the duties of directors as long as they're independent. There's been an evolution of cases that Amy's going to talk about where it's clear that many venture-backed boards don't have a majority of independent directors. And the result of that is judges look with pretty heavy scrutiny on those things. And you add to that the context of down round financings where investors are wearing two hats. One hat is they're representing their venture fund, but on the other hand, they're on the board and they're supposed to be a fiduciary to the company. And that creates a conflict that's very challenging. And when there's litigation risk, the judges hold directors as fiduciaries. They don't care if they're employed by the venture fund. So those can be really tricky to navigate. Amy will talk about some bad case law, and we're gonna, as I said earlier, we're gonna try to give you some tips and tools for not being one of those bad case scenarios. Becky already covered the other thing, I think, sufficiently. We'll continue to deal with some of these down round provisions, but that's the number two thing that enters the discussion. What's going to be the terms? What are investors going to insist on in this tough environment with a lack of visibility where the leverage changes, and you see some of those that Becky already talked about. And then finally, employee equity and management equity implications. So when down rounds occur, the non-investors, the people that aren't participating in that financing get diluted, sometimes greatly diluted. So they're concerned about, do I have the right equity ownership? And boards are typically and should be concerned about, do they now have the right equity ownership post-financing because we've been heavily diluted? And sometimes in this environment, particularly early stage companies, the liquidation preference that Becky talked about just takes up the entire value of the company, leaving the employee pool and the common stock may be viewed as not having much retention or recruiting value. And in those contexts, we see things coming out of the woodwork like management carve-outs, where the teams say, look, the equities, given these tough terms the investors insisted on, we don't think the equity is really attracting us and retaining us. And so we need a contract of some sort. So we we see that entering the conversation. So with that, I'm going to turn it over to Amy to get into a little more detail about these board duties I alluded to. Amy?
Sure. Thanks, Steve, and hi, everyone. So for the remainder of our presentation, we'll talk first about governance issues, and we'll also talk about structuring and technical issues, since those are the two big buckets of issues that down rounds raise. So to begin with the governance issues, we wanted to talk about the basics first. Fiduciary duties and how to think about conflicts of interest and how they figure into down round financings. So keep in mind, all directors owe fiduciary duties of care and loyalty to all stockholders. And those duties run to everyone, although we'll talk about a little tweak on that, but they run to everyone, regardless of whether a director is affiliated with a fund, regardless of whether it's appointed by a particular class or series. Directors have to remember that those duties run to everyone. And that's really the essence of some of the issues that we have in the down round context. So from there, what we really want to focus on is conflicts of interest. So you've got your duty of care, which is very process oriented, and that requires directors to have a good process, be engaged, deliberative, ask good questions. We can help make sure that boards do that. The other duty is the duty of loyalty, and that's where conflicts of interest come into play. The duty of loyalty says that directors need to act in the best interest of the company and its stockholders as a whole, rather than out of some personal allegiance or interest. And under the duty of loyalty, the courts can take a really close look at whether there are conflicts of interest and whether the litigation stakes get a lot more serious if there's a conflict of interest. So thinking about the types of conflicts of interest we have in the down round scenario, let's walk through a few of those. One important concept to keep in mind is something that's materialized very strongly in the Delaware case law in the last 10 years or so. And that is the perception of a disconnect between the preferred stockholders and the common stockholders. So keep in mind, the judges have increasingly and strongly said that where you've got preferred stock terms that address the topic at issue, the sale of the company, this can be relevant for financing rounds as well in some respects. When the preferred stock terms address the issue at hand, the rights of preferred stockholders are contractual in nature. The idea there is preferred stockholders are sophisticated, they've negotiated for these pages and pages of dense contract terms, and so their rights are governed by the contract. By contrast, the judges have said that common stockholders don't have those protections. They're, as I think about it, the unprotected little guys. And so courts have said, look, when preferred stock terms address an issue, I want you, board, to focus on the interests of common stockholders and really try to advance their interests as much as you can. So a quintessential example of where you've got preferred stock terms that address an issue is the sale of the company, where there's a clear liquidation preference waterfall about what preferred stockholders get. The judges have said there, those are your rights. Directors, please look out for the interests of the common. So keep that in mind when we're thinking about conflicts that exist around the boardroom table, that directors are often affiliated, obviously, with funds that hold preferred stock, but they're expected to look out very heavily for the interests of common stockholders. So that's one source of a conflict of interest. Another source of a conflict of interest is what Steve hinted at earlier, which is oftentimes directors affiliated with venture funds can be viewed as dual fiduciaries with competing obligations. So if the fund is investing in a round, even a down round, or otherwise getting some sort of special benefit, or preferred stockholders faring better than common stockholders, these are all things that might put venture directors in the dual fiduciary bucket. So we need to keep that in mind. A couple other types of conflicts here. Directors who have close relationships to the parties who are benefiting in a transaction are also viewed as conflicted. So if you've got a fund represented on the board by a director and another director has a history of investing with that fund or vacationing with the fund's principal or co-owning assets together, these are all the types of things where a judge could say, aha, you don't have a clear ability to exercise business judgment. You were maybe favoring the interests of someone you're friendly to. And we've seen a number of cases, especially in our space, taking a very close look at those types of relationships. And the final type of conflict I would mention relates to members of management. So we've had a number of cases in the private company context where the judges have said, if members of management are sitting on the board, there's a good chance they might be conflicted vis-a-vis the other directors because they rely on them for their livelihood. Or if those members of management are getting refresh grants or participating in a carve-out plan, the judges have said that renders them conflicted. It's all about whether directors are aligned or not with the unaffiliated stockholders. And so members of management can get a really close look in that context. So if we move on to the next slide, let's talk about how this all comes together in a litigation and why it all matters and how. So if you end up in a litigation, where you really want to be is the business judgment rule. And that's the standard under Delaware law where the judges say, we don't want to second guess what business people did. We're going to take a hands-off approach. And that's where you really want to be. But there are some predicates to that rule applying that can be hard to satisfy in the down round context. So you need directors to have appeared to have acted with due care, to have acted in good faith with a rational business purpose, but very importantly, without a disabling conflict of interest. So if you've got a conflict of interest around the board table, for example, the business judgment rule won't apply. So then you say, well, what happens from there? What happens from there is that you could end up in the entire fairness standard. And that is essentially the opposite of the business judgment rule. This is a standard of review that judges apply when half or more of the board has a conflict. So you go around the table and you nose count and you look at all the types of factors I just went through. And if half or more of the board has a potential conflict of interest, you can end up in this entire fairness standard. Another big issue that's come up in the Delaware case law lately is the issue of controlling stockholders. So if a venture fund or some other stockholder has a fairly significant stake, there's a chance that they can be viewed, a good chance that they can be viewed as a controlling stockholder. If you got a controlling stockholder that stands on both sides, meaning engages in a transaction with the company or gets some other distinct benefit different from the stockholders, that can also push you into the entire fairness standard of review. And keep in mind, controlling stockholders have been found at pretty low levels. We had a case a couple years ago where a PE fund was found to be a controller at 26% of an equity stake based on board relationships and influence. We have a very famous founder of one of our companies that was found to be a controller at 22%, just had common stock, but because of influence and board relationships was found to be a controller. So these are the ways you end up in this entire fairness standard of review. And I should note that we're seeing more and more of these entire fairness cases in the private company context. I often say to people that when I started out practicing in Delaware about 13 years ago, a lot of the litigation landscape was about public companies. And more we're seeing it about private companies. And to be clear, fortunately, most of our financing transactions and sales of companies and so forth don't get litigation, but we're seeing it more and more. And if you kind of get that bad lottery ticket, it's kind of more than a lottery ticket in terms of frequency. They're very painful litigations that can last a long time. So keep that in mind. But part of what we want to do today is walk all of us through the things we can do to better protect against those litigations or survive them if they happen. That's a big part of today's discussion. So if you're in one of these entire fairness claims, basically what the judge is doing is looking at all aspects of what a board did. Were the terms and pricing fair? Was the process fair? The judge looks at everything, and we'll walk through some of those factors in a minute. The underlying allegation is that the board breached its duty of loyalty and that board members could be held personally liable for damages, which is a potential remedy that exists when there's been a breach of the duty of loyalty. Keep in mind, it's not just directors. Members of management are more frequently sued in these litigations, sometimes with some real legs to those claims. And then venture funds are being named, either under the controlling stockholder theory that I touched on, we've seen that a few times, or they're being sued even if they don't have a control stake for aiding and abetting breaches of directors' breaches of fiduciary duty. Aiding and abetting is an old common law claim where any third party can be named for knowingly participating in a fiduciary duty breach. And so we've seen venture funds named that way multiple times as well. So stepping back from that, we think it's pretty important for investors and companies to be attuned to these issues and to try to mitigate risk. So if we move on to the next slide, we just want to give you a sampling of some of the litigations we've seen in Delaware over the last several years. This is far from all of them. These just really are some of the most interesting ones. Won't go through each and every one, but to give you a flavor, the Trados case was a real watershed case back in 2013. And that was a case where a private company, venture-backed, sold for about $60 million. The preferred stockholders got all of the proceeds. It was not a great deal for them. They only got 90% of their liquidation preferences, but the common received nothing. And the court looked and said, okay, a majority of the board consists of principals of funds who held preferred stock, or members of management, or other board members with the types of close relationships that I touched on earlier. The court therefore applied entire fairness. There was over 4 years of litigation, depositions, trial, the whole thing. The court ultimately did not award damages, said that the common stock really wasn't worth anything, but it took a long time to get there. The next two cases that you see here, Nine Systems and Bloodhound, these are interesting cases where a company did down round financings or other dilutive insider-led financings, and then turned itself around a bit, sold a few years later, and there were stockholder claims against the deal. And stockholders looked backward and said, aha, you did these insider-led rounds, your disclosures weren't very good. I now realize that I was diluted. I want to challenge those and the sale of the company. And the court let the claims go forward on the basis that the prior disclosures in the down rounds had been bad, and therefore stockholders still had a bite at the apple to sue about those rounds. And so Nine Systems went on for years, a couple $1 million, and attorney's fees were awarded against the directors and their funds in favor of the plaintiffs. Bloodhound privately settled. So those are really good indications of how, if we don't handle our down round financings well, and we turn the company around, we might have stockholders come back and haunt us down the road. A couple more here, Oak Hill. We just actually got a post-trial decision in that one. It's an update to these slides, just came out 2 days ago, where a preferred stockholder ended up in an entire fairness litigation over the redemption of its preferred stock. We have good technology that sold at a very deflated value, and there was some very significant litigation there with the parties settling for $50 million. We had a claim against NEA in a financing context a couple years ago. And then very interestingly, in early 2020, just a couple months ago, we had this case called Dealer Socket that's relevant for the financing round context. So sometimes, well, oftentimes when you're doing an insider-led financing round, including a down round, people will say, well, why don't we do what's called a rights offering and let all stockholders participate in the round? And people hope that that will dissipate the benefit and make everything look more even-handed. And that's what this company did here, a rights offering. The majority stockholder was a PE fund and led the financing round, and it ended up in front of the court on a pretty emergency basis, very fast-moving litigation. And the court said there was a strong claim here against the PE fund and the board, and he didn't really get behind the idea of a rights offering solving the conflict here. The court noted that the rights offering was conducted over the holidays. He viewed it as being done very quickly with limited information to stockholders. And he generally was skeptical and said, I don't know that stockholders truly have an equal right to participate in these contexts. They may not have the money, they don't have the same information, et cetera. And so the claims went forward and the parties eventually settled. So if we move on, there are some lessons that we can start to pick up from these cases. And we'll talk about affirmative, proactive things we can do, but here we'll start with the specific criticisms that we see coming out of these cases. So when we look at all these cases as a whole, here are the types of things the judges are saying about a board process that was in front of them. The judges have said, look, I'm looking at your minutes and your board decks, and I don't think the board members understood their fiduciary duties. I don't think they understood that they ran to stockholders as a whole. I don't think they understood the role of common stockholders. I don't think they understood conflicts of interest. And so we'll talk more about how to solve for that with your boards. The courts have said that there are circumstances where venture directors have unfairly excluded independent directors from board deliberations or had a lot of side conversations without them. In a lot of these cases, disclosures to stockholders have been viewed as inadequate, particularly not identifying how insiders benefited from a financing and the magnitude of the benefits to insiders. In some of these cases, stockholders were asked to approve financing documents, but were not given final copies of the documents, such as charter amendments and so forth. A big one relates to valuation. Got a couple criticisms here from the courts. Courts really don't like it if boards take casual approaches to valuations. In that NRA 9 Systems case, the court said literally there was a back of the envelope valuation where a very smart venture director sat back and said, well, here's how I think we should value the company. Courts don't like that. What they want to see is that you're bringing in members of management, maybe hiring outside advisors where it makes sense and you've got the money. We've also seen 409A valuations come back and haunt companies in this context. So we all know 409A valuations are done for other reasons not relating to Delaware governance issues. But the judges and the plaintiffs have still seized on these and said, aha, maybe a year ago, you had a 409A valuation where you said the fair value of common was $1 a share, and now you're saying it's worth nothing and the preferred stock's in really bad shape. And so the judges have said, why did you say that back then about your 409A valuation, but you're saying something different now? The issue of a financial advisor, as I alluded to, comes up. There was one case where the company was paying pretty good amounts for a name change consultant, but engaged in a down round financing and said, well, we can't afford a financial advisor. So that looked bad in hindsight. There are definitely circumstances where companies cannot afford financial advisors. We'll talk more about that, but we want to be cognizant of this criticism. And the final thing to draw out from these cases is, again, the criticism toward management benefits. So in these cases, the judges have generally looked at carve-out plans and new equity grants and said, there are two problems with these. They render management members of the board more conflicted and oriented away from the common stockholders. And they also represent a further diversion of value away from the unaffiliated stockholders. So those are frequent criticisms we hear in the cases. Now we want to move on to, what do you actually do about this? And again, we think it's in the best interest of companies and investors where they can to be really attuned to these issues so that you won't be attacked for everything you did and then have these things come back and haunt you. So when we think about process mechanisms to use, we want to start on this slide with some big picture type mechanisms that may or may not be practicable, but they need to at least be reviewed and thought about, even if they're not in the end something that you want to do. Some of these can actually get you out of that entire fairness standard and get you back to the business judgment rule, which is part of why we want to pause over them. So if we think about an independent committee of directors, if you have independent directors and you properly empower them to negotiate and approve something, that can actually counteract and cleanse a board conflict. Same thing with a disinterested stockholder vote, where you put the transaction to your unaffiliated stockholders and say, please approve this. The courts have said if you can get a majority of the unaffiliated shares who've gotten full information and haven't been coerced, if you can get that kind of approval from them, that can also cleanse a board conflict. Now there's a footnote on this and it gets a little textbookish, but bear with me. When you've got controlling stockholders, they're viewed as so powerful that you need both of these mechanisms, an independent committee and a disinterested stockholder vote, and you've got to do them just the right way. But if you use both of those with a controlling stockholder conflict, that can get you back to business judgment. Now for all of these, or for both of these, we realize you may not have independent directors. Frankly, people may not be willing to hand over the keys to them, even if they did. And you may not be able to get a disinterested stockholder vote, especially in, say, a down round context. And then you've got to figure out who your disinterested stockholders even are. But these are important things to talk about, and we do see companies use them sometimes. The final thing I'll mention, and then I'll hand it over to Steve for his reflections on this, is again the issue of a rights offering. So they will come up in the down round context and people will say, well, does that cleanse our conflict? They might be a good choice in terms of getting disclosures out to stockholders and looking more even-handed, getting the clock running on claims because you're bringing stockholders in and letting them know what's going on. But they may not get you back to the business judgment rule based on the recent commentary from the courts. So just know that these cut in different directions for us. Steve, do you want to add anything to that?
No, I think that's great, and we can move on to some other things that you can consider. And let me say at the outset that some of this to some of you may seem like a lot of legal stuff and complex processes, and not practical when you're small, you're running out of money, and you don't have time. And we get that. We're often as lawyers, we have clients in those situations all the time. So we're not going to tell you you have to sort of do all these things all the time. I think what we want to do here is to make you aware of how the courts look at these and the risks, and then importantly suggest that you really look at your litigation profile. It may be that you're a small company, everybody's pretty friendly, there's no angry ex-founder or CEO, or there's the structure is pretty small, and so you just assess the risk is pretty low of getting sued as a result of this financing. And if that's the business judgment that you're undertaking, then I don't think you need to be as worried as a situation where it's a highly dilutive financing, a lot of people are getting hurt, you have a lot of investors not participating, ex-employees, people who are going to be angry. And there, what we're saying is, okay, if the litigation risk is greater, you should consider doing some of these things that we're suggesting. And some of these aren't very time intensive or expensive. Some of the cases reflect just self-inflicted wounds where just a little bit of a tweak in process might have had a different result, might have had the judges looking at it differently. So first, you should make sure that the board understands its fiduciary duties, some of those intricacies that Amy mentioned, particularly when the conflict exists and when the duties run to the common. Make sure the board understands that. The judges mentioned that in some of the cases that Amy referred to, where they said, this board didn't understand what their duties were. All directors should be included in board deliberations. If the director has a conflict because the director who's representing a venture fund is proposing to do a down round financing, that at the appropriate time that director should be recused from those discussions because they have a conflict. Make sure that all information is being obtained given the time allotted and the financial realities that you find yourself in. One of the things that I think is pretty easy to do, and I think the judges don't like, is when the board just didn't do anything. It's like, okay, look, we're going to do this down round financing. We have an investor proposing it, and we're not going to do a market check at all. We're not going to explore any other possibilities. We're just going to kind of go ahead with the first thing we see. And that's a really bad record if the litigation is high, because it doesn't look like the board's doing its job at assessing the facts and exploring alternatives and acting in the best interest of stockholders. So don't set that table for yourselves if you think the litigation risk is not trivial. Financial advisors, for big deals, that shows that you're getting external advice about alternatives and fundraising. Larger companies do that. Obviously, bootstrapped and Series A companies aren't going to pay a lot of money to a financial advisor, but where you can and where the dollars are available, that helps. Amy already talked about valuations. Make sure that's clear. Disclosure to stockholders, hiding the ball is another thing that's going to get you in trouble because it looks like you're a bad actor if the disclosure to stockholders looks like it's not being upfront. Amy talked about the management benefits. It's good to sort of have a sense of what's the market, why are we doing this, not just sort of approve it in a vacuum. And finally, and I think this is pretty important, and this is an easy thing to do, which is often overlooked, but we spent a lot of time just now talking about record and process. And if you do some of those things, or if you have a lot of time and money issues and don't reflect it or your process in the record, the judges have nothing to look at. So if you're going to take the time to be thoughtful about a good board dialogue and a good process, make sure whoever is taking those minutes, ideally somebody like Becky or Amy, who's experienced at taking minutes, is doing a really good job reflecting the process and deliberation. And if you're not doing some of these things, the reason you're not doing them because, hey, look, we only have a week and then we're going to run out of cash. So here's what we think is reasonable to do given the time afforded, and have a record of that. Because if the minutes, are really thin on that, then trying to gin that up with the benefit of hindsight in litigation is not going to be as persuasive as a good, thoughtful set of board records at the outset. Okay, I think we can move on to the next slide. Becky?
All right, so I'm going to discuss some of the ways that we can actually structure a down round financing. Two features that we see very often are recapitalizations and pay-to-play provisions. So when would you do a recapitalization? Typically when you need to right-size or flatten your capital structure. So an example of that is your existing investors are no longer supporting the company. They're not putting any new cash into the company. The company needs money, and the current preferred stock liquidation stack is too high in proportion to what the company's current valuation is in order to attract new investors to come and put money into the company. So there's a couple of ways to accomplish a recapitalization. The most common, and what you think of the most often, is we would convert a class or series of preferred stock into common stock. Another way to accomplish it is through a reverse split of outstanding stock, or through a reclassification of an existing preferred stock into a new class of stock. So an example of that last one is you would convert your existing preferred stock into perhaps a junior preferred stock, and that junior preferred stock will often have a lower liquidation preference. So maybe they take a 50% haircut, or it can even be as great as taking a 70% haircut, to where the liquidation preference of that preferred stock is now only 30% of what it originally was. And then the new money purchases a senior preferred stock and comes in on top of the newly created junior preferred stock. As Steve talked about earlier, a really important consideration when doing a down round financing is the impact that it has on the current employees, which are usually hold common stock and are heavily diluted in these types of transactions. So it's important to keep them incentivized. So often recapitalizations will include a large option pool refresh and new grants to the key team members. Another common structuring tool is the pay-to-play. A lot of people think about this when they think about down round financings. We use it to encourage your participating investors to participate, or if your existing investors to participate in a financing. And the way that it works is that investors need to purchase their pro rata portion in order to preserve some of their rights. So this could be an all or nothing approach, meaning you have to buy 100% of your pro rata in order to preserve the rights of your 100% of your preferred stock, or it could be proportionate, meaning if you buy 50% of your pro rata, you're able to save 50% of your preferred stock. And then the stick to all of this is that the non-participating investors are converted to common stock or some other junior security. Believe it or not, there's really not a lot of case law on pay-to-plays, but I'm going to turn it over to Amy to talk about one of the key points one of the key cases we do have on point.
Sure. And that's right. Even though we do have more and more private company case law, and we have some case law rising out of down round context, we have very little case law dealing with actual pay-to-play provisions if you choose to use those in your down round. One big case we have, our firm actually litigated back in 2004. That was the Watchmark case. And that was a situation where a company used a pay-to-play feature. They built it into their charter. We'll talk more about that in a second. And the court actually dismissed the claims. The claims were brought by preferred stockholders who weren't happy with the down round financing. But the judge looked at the facts and said, you're pretty well-heeled preferred stock investors. You knew what was going on. Everyone had an equal chance to participate. There, the company's process looked pretty decent. They had good reasons for raising this money, and the judge just wasn't sympathetic to the preferred stockholders who complained. So it's a very interesting case.
All right, so let's talk then about the different options that you have in terms of when pay-to-play provisions are implemented and the type of pay-to-play that we would use. Some companies may have pay-to-play provisions in their current charter that would apply to a new financing, but that is actually pretty rare right now. So what we see more often is that the pay-to-play is added in connection with the financing in which it's going to be triggered. I am cognizant of the time, so I'm going to try to go through these a little bit quicker. There's a couple of variations. One is we rely on the auto conversion feature in the company's certificate of incorporation. Basically, what this means is usually by a vote of the preferred stock, all that, maybe it's a majority of preferred stock, can convert all preferred stock into common stock. And then what we do in the stock purchase agreement relating to the new financing is we allow any participating investor to then exchange that common stock that they just received upon conversion of their preferred stock for a new series of preferred stock. And anybody who doesn't participate remains in that common stock position. The other way that we do it is through actually amending your certificate of incorporation to include a pay-to-play provision. And this can be done either on the eve of a financing or so that it applies to that particular financing, or it can be put in place now, but only apply to a future financing. Out of the two of those, we typically see it happen where it is applying to the financing now. And then the other thing I would say is that when all of these instances, when we're talking about preferred stock being converted to common stock in connection with a pay-to-play, it's not always that it's on a one-for-one basis. Often we'll see it be more punitive than that. And you'll see it be more punitive, particularly if you have a really messy cap table that you're trying to clean up. And historically, we've seen as much as, for every 10 shares of preferred stock, you only get 1 share of common stock in order to accomplish that. Now, there are a lot of technical issues involved in each of these conversion mechanisms. I'm going to turn it back over to Amy to cover those.
Sure. And what we want to do here is just give you a flavor of the types of technical issues that come up so that if you're embarking on a down round, you've got a sense of what you might have to contend with. And it's all the more reason, as you'll see, these issues get a little delicate, to make sure that you've got counsel on the scene, whoever that may be, who knows their way around these issues. So one thing to consider, like Becky said, you might have in your pay-to-play situation a desire to take the preferred stock down to common and flatten them. And maybe the idea is participants in the round will get to exchange that common into something else and end up in a fine position, but a lot of times you do see a flattening of the preferred into common. And so one way that you could do that potentially is to look at the company's auto conversion provisions in the charter. If you look at the part of the charter that often says all preferred stock converts on an IPO, or all preferred stock can convert upon certain votes of the preferred stockholders, you might be able to use that latter provision, that sort of voluntary provision, if you will, to flatten your preferred. And so sometimes you'll see a majority of the preferred can vote to convert all preferred out of existence. So you might use one of those provisions here. But if you're thinking about that, there are a couple issues you need to think about. Can you get the required vote? Is it achievable? More and more you see some investors on a series basis get a series block on such conversions. And so depending on who holds the stock and holds a series, you may not be able to get those votes. If you can get the vote, it can be nice if that's what everyone wants to do as part of their structuring, and it can prevent the need for a charter amendment to actually flatten the preferred into common. And we had a case on this back in 2012 in Delaware, where one of these auto convert provisions was used. A preferred stockholder was not happy, brought a lawsuit, and the court basically said in 25 pages or so, what are you complaining about? This was a right that was built into your very own terms. You were converted out of existence. There's really no adverse effect that you can complain about. So if you can use these provisions, they can be very helpful, but they may not always be available depending on the overall structure and approach of the pay-to-play provisions. So if you really don't want to convert your preferred into common and you want to convert them into something else, you may not fit within the letter of that provision. Or if you want to use a harsher ratio than a roughly 1-to-1 conversion, which is what those often contemplate, these provisions may not get you where you need to be. If we move on to the next slide, here's another approach that you might see that Becky alluded to. And this would be where a company doesn't use one of those provisions I just described, but instead actually amends the charter to put in a pay-to-play provision that'll either be triggered down the road or that's being used right now. And if it's being used right now, the idea would be to say something like, all right, well, once this charter amendment goes effective, we're converting all of our preferred into common. And then maybe people get to pull up into better stuff if they participate. Or sometimes people will say, although there can be questions around, with the best approach, but sometimes companies will put in a provision that says participants will retain their preferred and non-participants will be converted into common. So like a little bit of a discriminatory charter amendment, if you will. So that might be one mechanism you can use in a pay-to-play provision. The trick, though, when you amend a charter is to think about the different knock-on effects from that. So whenever you do a charter amendment under the Delaware statute and also a company's protective provisions, you need to figure out if you trigger class or series votes of the preferred stock. And these can often raise some pretty tricky interpretive questions, especially under the class and series vote provisions of the Delaware statute. So you've got to navigate through those and figure out, can we get the votes? Do we want to take a conservative approach, an aggressive approach? Do we need a legal opinion, et cetera? When you use the kind of discriminatory approach in the charter I mentioned, and I'm using that truly technically, I'm not saying there's anything inherently bad about it, but where you treat shares of the same series differently depending on participation, you'll probably navigate through that with someone like me or Steve or Becky about what works under Delaware law, how far can we go. And then something else to just have in mind in this context is the benchmark merger. That's named after some cases that we saw rise up about 15 years ago, where a company wanted to do a financing round, had some protective provisions it couldn't get the vote under, did a merger with a dummy sub to get around those provisions and amend the charter in the merger, because there's an idea under Delaware law that if you do a dummy merger, you might be able to amend your charter that way and sidestep some protective provisions. But that's why the market started to say in protective provisions, well, you can't amend the charter or do things that are bad to me by merger or otherwise. So when people are really getting down to brass tacks in this context, they can think about trying to end run the protective provisions, and the existence of by merger or otherwise can actually be a pretty big issue. And investors oftentimes want to make sure they've got that protection. All right, so if we move on to the next slide, a couple other final things to touch on. Reverse stock splits, like Becky said, you might see those, but you need a charter amendment to do them because you're changing the stock, and that's how Delaware law works on this. Again, you need to think about class and series votes under the statute or protective provisions that might be triggered. And then finally, probably no matter how you crack it, you'll be contending with anti-dilution adjustments. So there you want to think about, well, could we live with these? Could we let them happen? Do we want to try to get waivers of them? Now, for that, you generally will need waiver provisions in your charter that you can actually avail yourselves of. So you need to see if they're in there and if you can achieve those votes. Or do you want to consider amending the charter to basically undo the effects of the anti-dilution adjustment, but you'll be back to thinking about class and series votes issues like we touched on earlier. So if we move on to our final slide here, we'll wrap this up quickly and move to Q&A. I think we're just about right on time. Takeaways. We won't go back through all of this in extreme detail, but just stepping back, things that we want to think about as we deal with down rounds. We think we will see more. We are starting to see them. Pay-to-play provisions may be involved, but are not always involved. They don't always go hand in hand. The fiduciary duty and process issues and stockholder litigation risk can be a lot more significant given the insider interests and the nature of the round. And oftentimes you may not see these issues come up until the company turns itself around. So we all want to slow down as the company and as investors to think about how to have better hygiene and have a better process. You might end up in the entire fairness standard. You might be able to do something like a committee, disinterested vote, et cetera, to avoid it. But there's a good shot that you'll end up in the entire fairness standard if litigation arose, depending on how your process looks. But what we really want people to keep in mind there is because the entire fairness standard could apply, it's not a reason to just kind of throw your hands up and not have a good process. If you end up in one of these litigations, you can fare a whole lot better, and some companies have, by having a good and defensible process. So again, goes back to understand fiduciary duties, understand conflicts of interest, think about all reasonably available information and alternatives, don't have blinders on, document why you're doing this particular round and why you've got to do it and what your circumstances are. Use advisors where you can. Where you can't afford a financial advisor, explain it in the board minutes, show that you thought about it. Be careful about your board deliberations, actually have meetings, don't wrongly exclude directors, watch your disclosures to stockholders, think hard about valuations, and make sure that your legal counsel are really taking good minutes and building good records. You can really help the board tell its story contemporaneously. Steve, any other things you want to add here?
Yeah, just the last three. If you are doing a down round, obviously the employee equity structure is going to be impacted. So you need to think about the retention and recruiting value of that and the impact on that. When you're in the heat of doing a down round, you're struggling to survive, and litigation's unlikely, but most of these happen when there's a turnaround and there's money available. So keep that in mind as you're thinking about process steps. And you've introduced now to some of the technical issues that make these pretty complex. So as Amy said, you want to have a good advisor. So we can now move to Q&A.
Amazing. Thank you so much, Amy, Becky, and Steve. Great overview. We've got some good questions that have come in. So I'm going to start with this one. Can you talk about common versus preferred stock briefly?
I can jump into that really quickly, hopefully. Yeah, for those of you that didn't quite understand that distinction, think of investors getting preferred stock because it has certain preferences, and the management team and employees getting equity. And because of that, the preferred usually has rights to get out the door quicker, and a merger maybe has a multiple return on investment rights to get out, and other kinds of price protection that we called anti-dilution protection that we talked about. So that's the distinction. Investors negotiate for preferred, and the management team and employees usually get common.
Amazing. And Amy, in your first case, 90% of the funding goes to preferred stockholders, but nothing went to common. Is it true that under liquidation rules, the preferred takes preference over common, and thus common undertakes the risk of liquidation preference in return for uptick in valuations when common goes public?
Yeah, that would certainly be one completely fair way to look at it, and I don't disagree. The trick is that the judges have just applied a different outlook to it, which is when the board, by a majority or half, holds preferred stock, and the preferred stock fares better than the common in a particular decision, the courts have said, look, you don't need to do the transaction that put all of this in motion. You exercise discretion as a board. You're conflicted. That's why I get to apply the entire fairness standard. And then the courts just had this outlook that preferred stock was negotiated by sophisticated people. Those were rights. The common are unprotected. And so the courts have just oriented it very differently than what the question would suggest, even though I think the question's completely fair.
Amazing, thank you. Another one that just came in regarding your point, Amy, on the 409A valuations. They're asking, wouldn't it protect the 409A protect a board, and how is that potentially a challenge? And I think you spoke to this a little bit, but.
Yeah, and Steve and Becky weigh in, I'll give a couple quick thoughts, but I think that there are times when a 409A valuation is something we use in our favor and say, look, we're doing a self-tender offer or something like that, take a different type of transaction. And we went out to a third party and got a valuation, and it was done carefully and people were thoughtful. It wasn't something quickly done. And we can use those to our benefit. And sometimes if the 409A valuation maps on to the value we actually want to give to things and it helps us defend ourselves, great. The trick is when a 409A valuation cuts against what you're saying now, right? Like I said, if it said that your common was worth $3 a share and then you do a sale of the company where you say it's worth nothing, there you might want to work with your advisors to explain why circumstances have changed and deal with the 409A head on. Steve, Becky, would you add anything to that?
I wouldn't. I think that's perfect. Becky, anything?
The only thing I would add is, a lot of times you may hear folks talk about get a 409A. It's really important. And that's usually in the context of granting option grants. That's almost always the why companies will go out and get the 409A, is so that the board can be protected when they set the fair market value for option grants. Is what Amy's alluding to is when you've done that for one purpose, i.e. granting options, the courts may also look at it for these other purposes as well when you're doing down round financings or sales of the company.
Amazing. Another one coming in. In pay-to-play situations, are preferred shareholders expected to contribute to pro rata, even if there are many preferred rounds, or are P2P pay-to-play typically aimed at the just last preferred round? Also, are smaller, earlier angel investors in preferred rounds who are not expected to add additional rounds also typically held to these provisions?
I'm happy to start this one off. Usually when you are implementing a pay to play, you have it apply to all preferred stock. And that's, I'll let Amy kind of weigh in on this, but I think that's usually the scenario where you're going to have the best protection. If you start saying it's only going to apply to certain series or certain investors, I think that's when you get into the discrimination issues and not treating all investors the same. So typically it would apply even to small investors that they would have to buy their pro rata portion. Now, one thing I would note is it doesn't always have to be that you have to buy 100% of your pro rata. As I mentioned, sometimes it can be proportionate, so that if you buy 50% of your pro rata, maybe that's enough to, and it kind of all depends on what the rules are that you set up, but maybe that's enough to save your preferred stock, or maybe it's enough to save at least 50% of your preferred stock.
Becky, I agree with that completely. I will say I've had a couple, just in this climate, a couple of situations where people want to do pay to plays and not subject all preferred stockholders to it, make some distinction between certain size of stockholders, et cetera. And we can do that. It can raise some tricky technical issues that we need to navigate through, but we can do it. But to Becky's point, you want to be careful about, how to look against other deals. Does it look fair? Does it enhance or improve the conflict of interest situation? And the final thing I'll mention that we should touch on is, in a pay-to-play transaction, like we saw in that Watchmark case, sometimes non-participating preferred can be plaintiffs, and they have arguments that in some ways they could be owed fiduciary duties, even though duties predominantly run to the common. There are some arguments they can make. So you do want to be careful about creating additional classes of plaintiffs with how you structure between your preferred.
Amazing. We have a couple questions on valuation, and I know that's a very large subject, but one of the, Julie asked, you mentioned that bridge financing may be used as a strategy to defer valuation negotiations. However, many convertible securities include a valuation cap, which presumably has some relationship to current valuation. What are your guys' thoughts on that?
I can jump in there quickly. Yeah, in almost all of these types of instruments, there's a discount to the next round of financing. And you're quite right, valuation caps have definitely become a part of the scene. So that's just something that's negotiated. From the investor's perspective, they say, hey, look, we're going to give you money now. We'll get a discount to the next round valuation at 20%. So we'll kind of when things calm down and the world's clearer, we'll get valued down the road, we get a discount to that. But if you're really successful and we kind of did the hard work of giving you money, we don't want the valuation to be too high. So we're going to set a cap on that. So you're quite right. That's definitely, particularly with sophisticated investors, Becky, I think we're seeing that frequently.
Absolutely. Absolutely. I would say it is a very, very common term in any type of bridge financing right now.
But it still doesn't negate the value of sort of kicking the can down the road if the alternative to that is getting a really low valuation today because the investor has all the leverage and you got to sort of stick a valuation stake in the ground.
Yeah.
Amazing. From the other side of the table, as an existing investor, how do you best prepare for a down round? What can you anticipate, check, or look for?
And you said that was from the investor's perspective, that
Yep.
question?
Yeah.
So I'll let Steve and Becky weigh in, but I think that as we suggested earlier, investors can face some risk in this scenario, either being named as controllers or aiders and abettors, or just having things blow up down the road. So my take, let Steve and Becky add to this, is, depending on the temperature of our investor clients, you do want to have an eye to the hygiene that's being used at the board level and whether unnecessary risk is being created. You want to kind of get a sense of whether the company could be doing more, be more thoughtful, just the little stuff that Steve and I touched on, and whether they've even got the right counsel on the scene, taking proper minutes and building the record. I think it's in investors' interest to do that, even if they need to set fairly harsh terms for the financing to get done. And on that note, the other thing I would mention is if you end up in that entire fairness standard, the terms and the structure will be looked at. So if things are harsher than they needed to be to get the money through the door, if things are a little overly punitive, that's not going to look good. So I think investors and the company want to think about where the sweet spot is for how to structure these things. But Steve, Becky, anything you would add?
Yeah, I just would add that, let's say you're short of, the company's running out of money, you're an investor proposing a term sheet. The board, including you, ought to encourage the company to go out and talk to other funds, talk to banks. If you're not going to do that, reflect why you're not going to do that, why this is the best deal for stockholders. So I'd probably go back to some of those takeaways and sort of pick as many of those as is reasonable to do given your financial situation, the time you're allotted. But if it's a really harsh dilutive financing and it's, and you take it quickly and the board does not have a good process, doesn't look at alternatives, the record's bad, you're really in a difficult situation should you get sued down the road.
Yeah, and I would just echo, it's not really a investor versus company. I would say companies and investors are aligned in this regard. When you're an existing investor, you're going to be part of the entity, that could potentially get hit with a lawsuit. So you don't want to structure something in a way that is going to increase the litigation profile or the risk profile for litigation, I should say.
Amazing. Well, I wish we could have more time, and there's so many questions, but you guys have shared so much amazing information with us on this topic. Thank you, Becky, Amy, and Steve, for joining us. And thank all of you live on our webinar and on our Facebook Live for joining us. Hopefully this was valuable. We hope you can join us at many more of these learn-ins that we will be doing. The next one is coming up tomorrow with Lauren Taylor. So if you check out our website, you can sign up for that one. We also are always interested in getting feedback on our learnings and to hear from the community of entrepreneurs that we